Hello and welcome. I have with me today Praveen Kumar, who is Chief Investment Officer at AlphaGrep Investment Managers. Welcome to the show, Praveen. Now, just wanted to know a little bit about your experience because you've had over 14 to 15 years in this industry, predominantly in the quantitative and what otherwise people know as the hedge fund space.
Yeah,
so tell us something about yourself.
Sure. So I started in 2008, started off with Edelweiss on the prop trading side. I was probably one of the first few people on the team there to set up the quant trading desk. And this is 2008, right? So we're building everything pretty much by hand on Excel, executing manually because algo trading hadn't really started. So that's how my journey started, was more of a quant researcher then. And then gradually we moved on to other asset classes, right? So the philosophy initially was to capture, or the objective was to capture more intraday strategies, right? So we were basically doing no overnight risk. So get in, get out, those kinds of strategies is what I started my career with. Ported that into other asset classes. So first was equities, then we moved on to currency futures, did that on commodities in India for a while. And obviously because commodities primarily derive their value from what's happening globally, we moved that to international exchanges. Then we also tried something similar on the Japanese equity markets for a while. So all in all, I think the similar philosophy did that for about 8-9 years. Then about 2017 was when I kind of moved into the asset management business within Edelweiss. There again, the philosophy or the objective was to see if we can port some of these ideas primarily on the quant side, not necessarily on the short duration trading side, into existing products or new kinds of products, right? So not just in equities, but even in debt. So did that for about a year, and then there was an opportunity within one of the long short funds that Edelweiss was managing at that time. So got into that role, was co-managing part of that portfolio, again, primarily quant-driven strategies for about a couple of years. And in 2020, that's when that fund was kind of winding down. And that's when like the conversation with AlphaGrep also started. So coincidentally, they wanted to like set up this business at that time. So it just kind of like worked for me, and that's how I'm here.
So now coming to AlphaGrep, because having studied your organization, you are very well entrenched into this entire algo trading and quant-driven methodology. Tell us something about what your firm does.
Sure. So AlphaGrep was set up, so just a little bit of a quick background and then I'll go into what we do. So AlphaGrep was set up in 2010 by the founders Mohit and Prashant. They're both like Wharton graduates, worked with some of the largest hedge funds in the US, then came back to India in 2010 and set this up, right? So like I mentioned, that's when like about 2008-9 was when algo trading was allowed in India, right? So AlphaGrep has its origins in high frequency trading, which is basically where you hold positions for a few seconds to a few minutes at max, right? So very high churn, high turnover, high returns, but obviously as you can imagine, very low capacity because of that, right? So that was the origin. Obviously technology is a big component of that part of a strategy. But then along the way, over the last 13 odd years, we've added capability in terms of medium frequency trading strategies, which is anything that holds positions from a few hours up to maybe on an average a few days, right? Obviously a lot more scalable, not as high return as high frequency, but capacity is where you can. And then along the way, we've transitioned from an India focused trading strategy kind of firm to a more global one, right? So as of now, we are truly in the sense like a multi-asset, multi-geography kind of a trading firm. And then obviously along the way, around in 2020, that's when AlphaGrep had decided that we want to move into the investment management space, right? So as we speak, currently we've got investment vehicles across 3 geographies, in India, in China, and in Singapore. But the overall philosophy for AlphaGrep, whether on the investment management side or on the prop, remains same. The core pillars are still data and technology, right? So data for everything that we do is predominantly systematic, and technology because everything that we do is automated, right? So both those layers kind of come together, and that's what we do at AlphaGrep.
So how many people are actually part of this entire investment or algo team?
So overall, I would say as of now, roughly about 170, 175 people would be part of the investment team, right? So, and the structure broadly is that AlphaGrep is split into different kinds of trading or investment teams. So there are anywhere between 15 to 18 teams, and teams could be as small as say 3-4 people, and the larger teams like 20 odd people, right? And again, the teams are not focused only on India, right? So a lot of these people, I think about maybe 50 odd people out of these sit outside India, because that's where the incremental capacity for alpha strategies lies, because India has its constraint in terms of liquidity and so on, right? So for active strategies like ours, which is why we've added capabilities on more international markets and strategies on that front as well.
Right. And now your profile as Chief Investment Officer, what does it entail?
Yeah. So initially when I joined, obviously my first year or so went in like getting the regulatory approvals, like doing all the dirty work, so to speak, right? But as things stabilized, and initially I was deciding what we put in different products, what kind of strategies we put in, what kind of allocation and so on. But now that things have stabilized, like my role going forward is going to be more on like what kind of strategies we can pick up into different kinds of investment vehicles, capital allocation between all of them, right? So like we've got multiple strategies, how do you allocate between one or the other? And then the third piece, which is probably one of the most important, is the risk management part of it, right? So how do you manage risk in traditional sense, and also there are exogenous or like risks that you won't really, a model wouldn't necessarily have anticipated. So that's currently my operating.
Right. Now, the key strategy that you employ is an absolute return oriented strategy where at a post-tax level, you're looking to give inflation adjusted returns, right?
Yeah.
Talk us through how that strategy is really built, and from all these different teams, what kind of strategies do you employ?
Sure. So I'll give a slightly elongated answer for this, right? So overall, as a philosophy, because the mandate or the objective is to deliver more absolute return kind of a product, right? So what that means is eventually we're trying to deliver returns which are not necessarily correlated with markets, and also have low volatility or low drawdowns at a portfolio level, right? So those 2 or 3 constraints itself determine what you can and cannot do. So a lot of strategies do not fit that kind of a description, right? And then there are a couple of pieces. So one is how do we identify what goes into a particular portfolio or product, and then is how do we mix and match that, which is the portfolio construction part. So the first part, which is the strategy selection or the design of it, that's like an entire life cycle of it, and which is not very different from what say a traditional discretionary manager would do and what we as a quantitative manager or trader would do, right? So you initially start with a hypothesis, you kind of test that with historical data, you cross validate it across different markets and so on. Once you're reasonably comfortable that this idea kind of works, which is when you take it live into the market, right? So you run it at a small size, give it some capital, and the objective there is to kind of just test your basic hypothesis, right? Test the kind of market assumption in terms of liquidity, what are you executing, is it creating any impact, and so on and so forth. Once you do that, then obviously then is the true test for the strategy, right? Which is what we call an out of sample performance. So you run that for some period at a slightly higher capital size, wherein you're comfortable with the amount of risk that it would do. Once it's established enough of a track record, then it goes into full scale production and you allocate real capital to it, right? So that's the strategy selection and the scale up part of it. Then the second part is how do you select these in a different kind of a product scenario, right? So if I'm say doing it for a particular investment vehicle, right? So then what we do is kind of identify some of these strategies, right? So let's say we have 15 or 20 unique strategies that work within this mandate. Then you identify which strategies have the capacity to take a lot of capital. Then you look at whether they are relevant for your framework or whether there are any regulatory challenges in terms of say exposure or leverage and so on.
Sure.
Right? Then the third one, which is probably one of the most important, is you're looking at a live track record to be there, because these are all historically run on backtests. You want some kind of a live track record to give you some amount of comfort. And then obviously the other parts is, are you comfortable with the risks that you're taking, whether the strategy is delivering a risk adjusted performance, because that's eventually what all these strategies are. So once you've selected, say maybe 3 or 4 strategies out of that, the next piece is combining them together, right? And here it's more about the interplay between the strategies. So you're looking at what correlations are, you're looking at whether you're getting a good diversification across market regimes, because not every strategy or style is going to work across all market regimes, right? So that's the intent of this entire approach and this strategy that we are doing. So it's a multi-strategy approach that we are following, and the reason that all those strategies exist are because of those capacity, track record, and the relevant risk-adjusted performance. And then the putting together part of it is more the portfolio construction. Sorry about the long answer.
No, absolutely. Now, the classic hedge fund industry in today's market is defined by the long-short variety.
Yeah.
Now, I know that you use long-short as a certain part of that overall periphery, but what are the other distinct strategies that go into this?
Yeah. So broadly speaking, so just to break it down in simple terms, there are 3 core strategies that we are kind of doing, right? So one is a market neutral pitch, which is basically always long a set of names, always short a set of names, right? So pure market neutral, classical risk premium play. So whether you play value or momentum or any kind of traditional risk factor. So that's one part. The second part is a more directional, pure trend following kind of a piece, wherein you're playing on short-term trends in the underlying markets that you're doing. So in this case, this is primarily India. So we do, say, Nifty and Bank Nifty. The objective is to capture short-term moves. So this strategy is designed to do well when markets are in a trend, whether up or down. And then the third piece is similar to the first, but it's more bottom-up in terms of stock picking, right? So whether I want to be long or short a particular name, I take directional bets on that, but then I hedge the overlying delta or beta with an index. Right. So then effectively what I've got is one which is a pure stock versus stock kind of a strategy. The second, which is a more trend following on the index strategy. And the third one is a more bottom-up stock driven. If there is momentum in, say, a particular name or a particular sector, that's what it's designed to capture.
Right. And typically, what are the weightages that go into these strategies?
So you could roughly assume that all of them are pretty much equally weighted. So that'd be like 30 to 40% is the band for each of them.
Right.
At any given point of time, obviously, this could be between, say, 30 to 40. So you are looking at like one third on average.
Right. Now, when you combine all of this together, in the hedge fund parlance, there is something called gross exposure and net exposure.
Correct.
And gross, just for the benefit of the viewers, is the long plus short, and net is the long minus short.
Correct.
That's the conventional way to understand this. How does this function in your strategy?
Yeah. So for a gross exposure, obviously, we are running anywhere between 150 to 200%, so the SEBI limit obviously is at 2x, which is 200%. Currently, we are running it at around 160, 170%, but we have room to scale that up a little more. In terms of net exposure, the historical average net exposure has been between 10 to 15%, which is why it's also more, which comes also more from the absolute return mandate, right? Because I can't run something which has very high delta and then to expect it to deliver across market scenarios.
Absolutely. And the key thing is risk management.
Yeah.
So what all goes into ensuring that you do not suffer drawdowns?
Yeah. Right. So in risk management, the core philosophy for us, what we are doing is obviously mitigate whatever risk you're not comfortable with and let the other risks remain, because that's what you're getting compensated for, right? So over there, we've got like a 3-pronged approach, right? So you've got a risk layer or a risk level at the strategy, at the portfolio, and then at the execution level. So I'll just talk about each of these in brief. So the strategy part is what is kind of inbuilt, right? So every strategy is supposed to do some things, it's not supposed to do certain things. So things like concentration risk, how much is my single name exposure? How much am I going to allocate to a single, within a strategy style also, there could be multiple signals that we look at, right? So how much weight do I put to a single signal? Things like that. And then obviously you're looking at, the next part is the interplay of all this, right? So while I've managed everything at maybe the strategy level, I've put my stop losses in place and everything at the strategy level is fine, I still don't know how the interplay between 2-3 different things works out, right? So that's where the portfolio level comes in, which is a mix of, some of it is inbuilt into the portfolio construction phase, but some of it is a manual overlay, right? So things like minimizing style risk, minimizing the correlation risk, right? So because again, every strategy will do well in certain kinds of markets. So minimizing that is part of the portfolio construction process. But then you still have an explicit overlay saying that even though I have, let's say, an X% limit on a single name at the strategy level,
Right.
I don't know how 3 different strategies might end up, right? So you have a manual overlay saying you want to stick to this kind of an exposure limit on a single name at the portfolio level. And then the third part is managing drawdowns within the portfolio level, right? Because there will be drawdowns for each of these strategies because these are not risk neutral, right? So they do take some amount of risk. So managing those in a systematic way. So again, where we have like a framework which defines when you want to scale down that strategy.
Right.
But the difficult part is when to scale that back up, right? So again, we've got a framework to when to scale down and scale that. So that's the second layer. And the third one, which is slightly underappreciated, is the execution layer of risk management, right? So here, what we are trying to do is diversify across different things, right? So one is time diversification of your signals. So what that means is, in simple terms, let's say I have a strategy which gets its signals or gets its trade every 4 hours or 5 hours or whatever, right? Now, the simple way to do it is I run it at market open, and 4 hours down the line, you just see whether you want to be long, short, or whatever, right? The more diversified or the more logical way is to basically run it maybe at every half an hour or every 1 hour or every 15 minutes. Do this on a 4 hour, but basically what you're doing is, instead of running it at one 4 hourly point, you've diversified that into multiple points, right? So what that does is not just diversifies your strategy risk, but also your execution risk. And then we look at things like how you want to scale in a position in terms of impact management. Again, for active strategies like ours, because costs and slippages matter a lot, that becomes a relevant aspect. So the execution layer of risk looks at all of these aspects, and that's how all of these 3 things put together work for us.
Understood. And finally, you mentioned about scalability of a strategy like this.
Yeah.
What do you think should be an optimum amount for your strategy?
So for our current strategy, what we've kind of looked at the numbers and worked what the position size, and this is obviously based on where the market size currently is, right? So what we've seen is obviously that for this particular fund that we are running, 100 million kind of a size is what we are comfortable with. Obviously, once we reach that point, we'll know what kind of impact or what kind of slippages we're seeing, right? But as of now, given the data that we are currently, that's the kind of size that we are looking to pause the fund for.
Understood. Praveen, it has been a pleasure to have you on the show.
Likewise.
Thank you so much.
Thanks a lot.
Thanks.